This is Nightly Business Report with Sue Herrera and Bill Griffin.
Market anxiety. A new report tonight puts a phase one trade deal with China in doubt, and stocks get knocked.
In the bullseye, Target blows past estimates and raises its profit forecast at a critical time of the year for the big box retailer.
Pushing up prices. The supply of single-family homes is shrinking, which means renting just got a lot more expensive. Those stories and much more tonight on Nightly Business Report for Wednesday, November 20th.
Good evening, everyone, and welcome. If you needed a reminder that investors still care about trade, today you got it. The market got the wind knocked out of it on a report that the first phase of a trade deal between the U.S. and China may not be completed by the end of the year. Uncertainty around trade also grew after the Senate passed a bill supporting the Hong Kong protesters. The House passed a similar bill tonight. And so today, the Dow Jones Industrial Average fell 112 points to 27,821. The NASDAQ was down 43, and the S&P 500 slipped 11. Bob Pisani takes a look at how a reported stall in trade talks stalled the market.
It was a rocky day of trading on Wall Street. Stocks starting the day lower, then taking a deeper plunge midday as trade fears, stop me if you've heard this, mounted once again. The Dow fell to session lows on a Reuters report citing trade sources saying phase one of a U.S.-China trade deal may not be completed this year and could slide into next year. This comes as Beijing presses for more extensive tariff rollbacks and as the White House still wants a deal that will address intellectual property, technology transfer issues, and the two sides can't seem to agree on this. If the market starts to believe that tech and intellectual property issues really are big conditions of a phase one deal, they might view that as a roadblock for getting any kind of bigger deal done at all. Any kind of deal we get could be little more than a kind of phase one light, meaning we get no new tariffs on December 15th. The existing tariffs remain in place, and maybe there's some agreement for the Chinese to buy agricultural goods. Phase one light, essentially. The worst case scenario would be no deal at all. Existing tariffs stay in place, and then maybe we get a heap of new tariffs coming in December. No surprise, we saw trade-sensitive names like materials and industrial tech, semis, all slipping. Apple was down more than 1%. Up until today, the market had been fairly complacent, frankly. It was a very narrow trading range the last few weeks. Low volatility, optimism, broad-based November rally, but the mood shifted a little bit today as investors try to figure out whether the markets can avoid some kind of sell-off going into 2020. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
There was a bright spot for the markets today. It was in retail. Yes, retail. Target stock took a victory lap after reporting better than expected earnings and revenue. It also raised its profit guidance. The shares soared by 14% to an all-time high. Courtney Reagan takes a look at what Target's still doing right.
Target hits another bullseye with its quarterly results. A combination of strong store traffic and online sales drove total comparable sales up 4.5%. The big box retailer says its strategy to use its store network to fulfill online orders is working. The 3 same-day order fulfillment services made up 80% of Target's digital comparable sales growth. It's also helping to lower Target's shipping costs.
When it's order online and pick up in store or drive up or fulfill by ship, about 90% of the cost goes away. So those economics look a lot like store economics, and we certainly like that.
During the upcoming holiday season, shoppers use those pickup services even more. Target saw strength in many categories, including apparel. Its apparel and accessories business grew 10% in the quarter compared to last year. Apparel was weak for other competitors this quarter, including Kohl's and Walmart.
I really do think that their private brands have been superior in terms of quality plus value. All right, and I think that the customer really finds that to be distinct and unique to Target's offering.
Food is another area that Target has seen improve. While only about 20% of its sales are in that area, much less than Walmart's 55%, it's an important traffic driver.
The food business is just gaining traction. I think Brian Cornell's strategy with food was spot on. We thought they needed to do it earlier. They didn't. They waited a little while. Food drives traffic. You get better exclusive and private label brands there on the home and apparel side. So when that traffic comes into the stores and on the website, you got more things to sell them at higher margins.
The big test, of course, starts next week with Black Friday just 9 days away. But Target CEO Brian Cornell is confident and said all the indicators suggest this is going to be a very solid holiday season. For Nightly Business Report, I'm Courtney Reagan.
Lowe's also reported higher profit that beat analysts' expectations. The CEO cited a solid macroeconomic backdrop, calming nerves after Home Depot's rocky report, which we told you about yesterday. The home improvement retailer said fewer discounts helped lift profit margins, and a new assortment of products attracted higher spending builders and contractors. The stock gained almost 4% in today's trading session.
Carl Icahn is betting against mall owners. According to the Wall Street Journal, the billionaire activist investor is likely the largest short seller now of mall debt. He stands to make millions if mall owners are unable to pay off those debts. That news sent shares of some of the major mall owners and real estate investment trusts lower in today's trade.
And as mall owners struggle with debt and declining traffic, the former CEO of Macy's says there are just too many stores.
There's too much retail space in the United States. There's way too much retail space. This has been a problem for a long time, but the bubble burst when the online business started aggressively growing. Think about it this way. 20% of the businesses, of apparel businesses now sold online. Well, 20% of the stores haven't gone away, and the total pie isn't growing, so something's got to give.
Greg Portell joins us now to talk more about the state of the retail industry, from malls to store closures and real estate investment trusts, or REITs. He's the lead partner of the consumer practice at A.T. Kearney. Good to see you, Greg. Thanks for joining us tonight.
Thank you.
I am mindful that more than 9,000 stores will have been closed this year alone. That's a record. And somebody like the former head of Macy's, Terry Lundgren, believes that we're still overstored by about 20%. So how risky does the bet against malls right now by Carl Icahn look right now? Is it risky at all, do you think?
Well, there's no secret that the U.S. has been overstored for quite a while. The challenge becomes, when do we hit that cliff? Because it's no secret that things will be moving around, consumers shop in different locations. So store closures by themselves really aren't the problem. It's the combination of multi-channel sales, distribution points, and a lot of other ways that the retailers are using the stores that really needs to factor into that conversation of being overstored.
Yeah, but those issues that you just mentioned aren't going to go away. Certainly, they're only going to probably increase. So you said when we hit the cliff. When is that, do you think? What's your gut sense?
We don't see it happening anytime soon. We have a retail environment where retailers in general have overinvested and over-indexed toward building up their digital capabilities, and that was right at the time. Mm-hmm. Now we're starting to go back the other way, where we're seeing a gap in spending on store improvements. We estimate about $100 billion worth of investment is needed in the retail physical space to meet the expectations of consumers going forward. So whether that is less square footage or not, it's still going to be an investment in the physical space of retail.
But what about malls themselves, especially when you consider that their biggest anchor tenants are those department stores that are suffering so much right now? What about the future of malls in America, do you think?
Well, it's very easy to group malls as a single unit, but it's a little bit of a mistake, because malls need to be where shoppers like to go and where traffic is. So malls that find themselves in high traffic, high volume locations are doing well, as to are malls that actually are appealing to go to. If we think about the old mall from the 70s, it looked like a military bunker. That doesn't draw consumers in today. They need light, they need space, they need activity, they need multiple uses. Those malls will be fine. The malls that are out in isolated areas where traffic has moved away from, or where consumers have shifted from, really are going to struggle.
All right. Greg Portell with A.T. Kearney. Again, thanks for joining us tonight, Greg.
Thank you.
Elsewhere, the Federal Reserve today released the minutes of its last meeting, where policymakers lowered interest rates by a quarter point. And during that meeting, many saw little need for further cuts. Here's Steve Leisman.
After Fed officials cut rates in October, minutes from their meeting then show they expected to stop cutting and remain on hold for some period of time. The minutes show officials thought after a 25 basis point cut, which was the third of the year, rates were seen as, quote, well calibrated to deliver moderate U.S. growth and a continued strong labor market. Most said the overnight funds rate controlled by the Fed in the new range of 1.5% to 1.75% was, quote, likely to remain appropriate unless the economy performed materially differently from what the Fed expected. At the time of the meeting, Fed officials saw a lower chance of recession. They also said the risk to the economy from the trade war, Brexit, and other global developments had declined. The U.S. economy was called resilient, and two Fed officials didn't want to cut at all. Still, the Fed cut because of concerns that manufacturing and export weakness sparked by the trade war and weak global economies could end up dragging down the labor market and the consumer. Officials outright called it an insurance cut. Now, after 3 rate cuts, Fed officials were clear in the minutes and in speeches since the October meeting. Rates have stopped going down, at least through the end of this year, and likely into a good chunk of 2020. For Nightly Business Report, I'm Steve Leisman in Washington.
Time to take a look now at some of today's upgrades and downgrades. We begin with shares of Kohl's. They were downgraded today to neutral from buy at Goldman Sachs. The analyst cited fading confidence in the retailer's strategic initiatives, especially after yesterday's disappointing earnings report. Price target now $48, and despite the downgrade, the stock rose a fraction to $47.22 one day after falling 19%. Canopy Growth was upgraded to buy from neutral at Bank of America Merrill Lynch. The analyst cited the stock's valuation after a 60% drop over the last 6 months. Price target is now $19. The stock was up 15%, also probably because the House Judiciary Committee today passed a bill that would lift the federal ban on marijuana sales. That's the first step in that process. Johnson & Johnson was given an overweight rating in new coverage at Cantor Fitzgerald today. The analyst cited the growth in its pharma business and said the liabilities the company faces from talc and opioid-related litigation is manageable. Price target $160. That stock was up a fraction to $135.94.
Still ahead, are drivers ready to plug in?
Everywhere you look at the LA Auto Show, you see them, electric vehicles. There is a wave of them coming, but is the public ready here in the U.S. to buy EVs? I'm Phil LeBeau. That story coming up on Nightly Business Report.
Oil prices reversed 2 days of losses today after a new report showed a smaller than expected build in U.S. inventories. The crude market was also supported by comments from Russian President Putin, who said Russia will continue to cooperate with OPEC production decisions. Domestic crude settled up 3% to about $57 a barrel.
Apple broke ground on its $1 billion facility in North Austin today. This new campus is expected to open in 2022 with 5,000 employees. The announcement came on the same day that CEO Tim Cook toured the manufacturing plant there with President Trump. The campus is going to expand Apple's Austin operations, which currently build the new Mac Pro.
10 Democratic presidential hopefuls are taking the stage in Atlanta tonight for the 5th debate. And there will likely be a lot of talk about policies related to the economy and business. John Harwood joins us now from the site. John, let's start with health care. The previous Democratic debates have revolved around the issues of Medicare for all, the private insurance industry as well. Do you think tonight's debate will?
Well, I think there's going to be something different about it tonight, Sue, and that is Elizabeth Warren has taken the political risk of saying how she would pay the enormous cost of Medicare for all. She wants to do it with a big increase in the wealth tax that she'd already proposed, with some other tax increases thrown in as well. I think that's going to shift the terms of the debate, broaden it from just whether or not you can get rid of the private insurance industry, as Medicare for all backers want, but whether the economy can tolerate and whether politically they can pass tax increases of the scale that she's talking about.
Speaking of Elizabeth Warren, how do you think the various candidates are going to handle the issue of her public arguments with billionaires, people like Leon Cooperman?
Well, I think that no Democratic candidate is going to defend the feelings of billionaires. However, some other candidates, like Joe Biden, are going to say we can't divide the country, we can't be punitive. We'd heard that from Beto O'Rourke before he dropped out in the previous debate. We need to bring the country together, cast themselves as more moderate, more broadly acceptable. And I think we'll hear that again from not just Joe Biden, but also from Pete Buttigieg.
And speaking of which, he's the candidate who has really surged since the last debate. What do we know, though, about his business and economic views?
Well, Pete Buttigieg is now leading in Iowa and New Hampshire. He's come on. He has cast himself as a moderate. He's hoping to inherit Joe Biden's support if Biden falls. He's proposed to reverse the corporate tax cut, take that rate back to 35% to pay for his health care plan. He's also talked about potentially a financial transactions tax, a carbon tax, and also a wealth tax of some kind. He hasn't spelled all that out. We'll see if he does that tonight. But you can bet that because of his rising position in the polls, he's going to take a lot of incoming fire from other campaigns.
Indeed. John Harwood in Atlanta for us. Thanks, John.
You bet.
Salesforce raises its sales outlook, and that's where we begin tonight's market focus, with the software company lifting the higher end of its 2020 revenue guidance above analyst estimates. Salesforce shares rose a fraction today to $164.20. Shares of Altria and Philip Morris both rose after Bloomberg reported that the FDA is going to end its plan to drastically cut the level of nicotine in combustible cigarettes. Back in 2017, the agency proposed cutting nicotine in those cigarettes to non-addictive levels in an effort to transition smokers to e-cigarettes. Now the world has changed in that regard, so Altria rose more than 3% to $48.45. Philip Morris was up a fraction to $83.48. General Motors is suing Fiat Chrysler, alleging that the fellow automaker bribed officials of the United Auto Workers Union during collective bargaining negotiations back in 2011 and 2015 in order for Fiat Chrysler to gain better wage and work practices. GM says the alleged bribery was authorized at the highest levels at Fiat Chrysler. Shares of both automakers dropped more than 3% in today's trade.
Bristol-Myers said a late-stage trial test combining skin cancer drugs missed its main goal of preventing a reoccurrence in some patients. Bristol-Myers Data Monitoring Committee, though, recommended to continue the trial unchanged. Shares of Bristol-Myers fell a fraction to $56.41. PG&E started shutting off power to about 150,000 customers in nearly 20 California counties to help reduce the risk of wildfires from expected high winds. The utility says its goal to restore power to those customers is by the end of the day tomorrow. PG&E rose more than 4.5% to $7.15. After the bell, La-Z-Boy posted earnings that missed expectations. The furniture retailer beat comparable store sales estimates for the company-owned retail segment. La-Z-Boy also raised its quarterly dividend 8%. Shares initially fell in after-hours trading. They closed the regular session down a fraction to $36.18. Also after the bell, L Brands reported mixed results with earnings in line with estimates but missed on revenue. The retailer saw a drop in same-store sales, especially in its Victoria's Secret unit. But shares initially rose following the news but closed the regular session down about 7.5% to $15.89.
At this year's LA Auto Show, electric vehicles, or EVs, took center stage. A number of new models are being introduced, but the question is the public ready for this new wave? As you saw, Phil LeBeau is there.
Next year is when a slew of new electric vehicles will be rolling into showrooms, from the Mustang Mach-E to the Porsche Taycan. So with so many of these new EVs hitting the market, is the public ready for them? Even the auto industry executives aren't quite sure.
Customers hesitate because, first of all, the price is higher, and secondly, it's a question of convenience.
Last year, we sold 140,000 electrified vehicles. We started 2013 with the i3. Going forward, this year we'll have 500,000 on the vehicle. In 2021, about 1 million electrified vehicles. Tipping point, hard to foresee.
I think it's just being able to provide great cars that people like, not because they're electric, but because they're great cars. And they happen to be electric.
Right now, EVs make up less than 2% of all vehicles sold in the U.S. And while there are dozens of new electric vehicles rolling into showrooms over the next 5 years, EVs are expected to make up just 10% of the market by 2025. Phil LeBeau, Nightly Business Report, Los Angeles.
Let's turn now to Rochelle Protusky to find out more about the demand for electric vehicles and when we could see sales take off. She is the Senior Manager of Research and Market Intelligence at Cox Automotive Mobility, where she focuses on electric vehicle markets. Good to see you. Welcome.
Thank you, Sue.
So what was your impression at the auto show, and what buzz did you hear about the EVs? Are consumers ready to really purchase them on a large scale?
So I think, consumers are really excited about the EV future. When we talk to them, 70% say they can imagine a fully electrified road in the next 5 years, but that's not fully translating to consideration yet. Only 4% are considering. But this auto show really proves what the future of EV is going to look like. It's starting to mirror what we see in new retail sales today, with introductions like the Ford Mustang Mach-E being one of those big opportunities.
I think one of the biggest concerns, though, is the infrastructure in our country for charging stations. There's just a dearth of them. I mean, are we going to see suddenly in the next couple of years a number of them being built around the country?
So I think we're starting to see new partnerships coming up, but that's definitely an opportunity in the U.S. is that growth in infrastructure, because consumers continue to question battery range, and until they see charging stations more prevalent at home and near their work, they're going to have some questions about the range of these vehicles.
You mentioned the fact that consumers are considering it, but what responsibility do the automakers have to try and dispel some of those fears or perhaps misconceptions about the infrastructure?
So I think their greatest strength is their dealers and empowering them with more information to help educate consumers, and having more prevalence of electric vehicles in their advertising will help consumers have those vehicles be top of mind for them.
Ford is planning to have 40 different electric and hybrid models on the road, or at least introduced, in the next couple of years. Is there that much demand for those vehicles out there, do you think?
Well, so I think much like Phil said, this is not about it being electric or ICE. This is about meeting consumer demand and what they like. And, if you're providing crossovers and SUVs and trucks, which are what is hot for consumers, then they're going to make that shift to electric.
Who do you think are the leaders? I mean, obviously, Bill just mentioned Ford coming out with all of these different models. But what other automakers do you think really are cutting edge in the EV space?
So I actually talked with VW today, and they have a very bright future when it comes to EV. I also think that GM has made a very strong stance in terms of an electrified future for them as well. And those are brands that consumers know and love, and so as they bring more electric vehicles to market, they're going to be the ones that they're willing to make the switch with.
Rochelle, thanks so much.
Thank you.
Rochelle Protusky with Cox Automotive Mobility.
And coming up, with home prices rising, affordability is falling, and the same is true when it comes to rentals. Here's a look at what we're watching for tomorrow. Existing home sales will tell us what impact mortgage rates are having on the housing market right now. A number of Fed officials are scheduled to speak on the economy, and here come more retail earnings results, this time from Macy's, The Gap, and Nordstrom. And that's what we're watching for on Thursday.
Macy's website was breached in October. The retailer said the incident affected a small number of Macys.com customers during a one-week period. The customer information exposed includes names, addresses, phone numbers, email addresses, and credit card numbers.
Finally tonight, the residential housing market in most parts of the country has been described as frustrating. Inventory is low, prices are high, and now there's also a potential shortage of affordable single-family rental homes because demand is hotter than ever. Diana Olick explains.
Anyone out shopping for an entry-level home knows the prices are high and the pickings are slim. Now, the same is holding true for rentals. As more Americans find it harder to afford a home, rental demand is soaring, especially for single-family homes. Kimberly Sestari is both a real estate agent and a landlord, and she's seen the D.C. rental market take off.
I think it's more of a millennial thing in that they have the income available for the higher prices on the single-family detached homes. They may have tried a condo, tried an apartment, but now they want some outdoor space, and they have the disposable income to use it.
The supply of rental homes is shrinking nationally. In the third quarter of this year, single-family vacancies were at 6.8%, down from 7.1% 1 year ago, according to CoreLogic. Supply is much lower on the low end, so rent prices there are increasing most, up 4% annually in September. Higher-end rents were up less, but in the hottest markets like Phoenix, Las Vegas, and Seattle, rents are soaring.
Rents are not going down. I have seen consistent growth year after year, and single-family markets in particular. People want that experience of having a yard, having enough bedrooms and baths, and I've seen increases consistent every year.
The number of single-family homes available for less than $1,250 per month has dropped 40% since 2013, according to Capital Economics. All this despite the fact that the single-family rental market ballooned during the foreclosure crisis. Investors bought thousands of distressed homes, growing the rental supply by 38% just between 2012 and 2016. Most thought that as the housing market recovered, investors would sell their properties for a nice profit and call it a day. But the rental income now is just too lucrative, so even more investors are buying more properties. For Nightly Business Report, I'm Diana Olick in Washington.
And before we go, here's another look at the day's final numbers on Wall Street. The Dow fell 112 points, the Nasdaq was down 43, and the S&P 500 slipped 11. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.